Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, Chief Market Strategist with Sticky Trades. And I hope you had a chance to watch the midweek report where on Wednesday I put out the message that we were finding hammer candles right across the board and we were expecting a bit of a bounce towards the end of the week, and that's exactly what happened. Did we hit all of the upside targets? No, but for most of them we came within pennies of hitting. And as I show you the charts moving into next week, I think it's very important that you keep your sights set to the downside. I believe October is going to be a very tough month for the buy and hold investor crowd, but I think it's going to be an absolute field day for our option traders who are loaded up on put spreads. Let's take a look at the charts. Looking at DIA, you can see the market did bounce after this hammer candle on Wednesday, and you can see that here is where the market gapped up today and then came right back down after the gap filled to continue to go lower. Now there's a lot going on this chart. We have a drop in volume here, and we are just over that key support level, which is this green dotted line. So I think on Monday we're going to see more or less a carbon copy of what we saw today. I do believe that we are going to go up in the morning on Monday, maybe even into Tuesday, but I think we're going to make a hard turn. And I know I'm getting aggressive to the downside, but I think next week could be a very tough week, like I said, where I'm expecting the markets to close below their key support levels. So keep an eye on the volume, keep an eye on this role reversal resistance up here, and also keep an eye on the oscillators because they're crossing here on the stochastic, but it could very quickly turn lower as we progress into next week. Looking at IWM as I go in alphabetical order, here's one came within pennies of hitting my upside target. And while the oscillators are going higher, I think we're going to see an about face on the IWM. And I'm going to be conservative on the downside there, putting a downside target of 175.49 on the downside. All the same reasons that I talked about on the diamonds. I think we could open up higher but then wind up lower later in the week. Looking at the Qs, again, here's another one, came very, very close to hitting my upside target. We did not fill that gap, made an attempt to do that, but did not fill it. I think the Qs, like the diamonds, could make a move a little bit higher, possibly filling that gap, we'll see, or even hitting that target from last week. But I think we're going to close below this fan line. That is number 5 fan line. Remember when I talk about fan lines, this was number 6. I said when fan lines are broken, especially when there are 6 of them, you have a 90% chance that prices will drop to the next fan line in the sequence. After fan line 5 is broken, that 90% chance drops to an 80% chance, and that is where I think we're ultimately going to go. I think we're going to start breaking below that fan line. And if I take a step back and look at the weekly candles on this, you'll see how far down the Qs actually could go before we hit that number 4 fan line. This is 4. Again, this is 5. I think that's going to be breached. And 6 is already broken. And there we go. That could be the free fall that we're expecting in the month of October, which could wind up, and I know I'm putting my neck out by saying this, but we could see a meltdown in the month of October. So be very, very careful if you're long anything or your option traders have a positive delta. Be very, very careful of that. Let's move on to SPY. You can see here we made a move to bounce after the Wednesday call. Remember, that was another hammer candle. We have an increase in volume here. However, that is mainly from the sell-off later in the afternoon today. I think that, again, the spiders can go up. I don't think we're going to hit that target on the spiders from last week. I think we're going to go up, though, and then make another hard turn lower. This is a forecast that's going as far out into October 10th. So for option traders that week, we are going to be rolling out our spreads, taking in a whole bunch of cash there, and that's going to be an exciting week for us as we roll our positions out into November. So again, to reiterate, upside target of 433.43, and then right back down into the middle of October at 424.46. Looking at the VIX, you remember I talked about this on Wednesday. I said that we will most likely pull back to this roll reversal, which is now support. Remember, former resistance, once broken, like it broke here, turns into support. And I did say that there was a very high probability we would pull back. We did that. But look at that shadow, folks. That is a long shadow. That's very bullish. Again, I think the VIX might drop a little bit more, but I'm not even going to go with that downtick. I'm going straight up from here. I'm getting pretty aggressive, but I think that the VIX could make a move to test that high up there around 1961. Now, I want to talk a little bit about SLV. I'm very public about this. On Wednesday, for those of you that were on the rapid fire analysis segment, put an upside target on SLV right there at $20.96. I did not have time to put out a special alert on YouTube or notify our members because on the opening I was on with one of our VIP members, John, out there in Deerfield Beach, Florida. He and I were more or less talking in the pre-market hours and how silver was gapping up. 15 minutes after the market opened, I sold out of 5% of my position on SLV. I tend to do that first. Sell the 5% now, wait and do higher percentages later. And what happened is silver came right back down, not only filled that gap, but is now breaking out below that trend line. Now, for those of you who are long silver like me, be ready because that could go much lower. And I say much lower. Where is that? There's a gap fill all the way down here around 19.5. Believe it or not, I think silver can get down to that level, at which time, remember, I've created cash available for myself when I sold out of 5% of the position. So I'm going to be a big buyer down at that level, and I will even add more cash to that position if it gets down to fill that gap. Because remember, 80% of the time gaps fill, and then after gaps fill, we have an 80% chance that'll go higher. I know there's some people at the competitors who are questioning the gap fill rule, but that's something I've been tracking for 40 years, and it absolutely works. Don't take my word on that. Go back and look at any chart, any gap, and you'll see that 80% of those gaps fill, and then right after they fill, prices reverse. It's pretty phenomenal how that works. And that's because a lot of people use the gaps as price targets to get in and exit strategies when they're looking to get out at a gap fill point because they know the prices are going to reverse. Now let's go right to the geopolitical news. I have a lot for you here. Oh, by the way, if you go right there at the bottom of that page, right there, see where my finger is? You go right there. While I'm talking, you could click on the subscribe button and subscribe to our channel so you won't skip a beat. Then you can click on the notification bell, which is at the very top of the page up here. And then when I send out this video and my comments, you'll be notified either through your phone or through your YouTube channel. So make sure you click on that subscribe, click on the notification. And with that, let's go to the geopolitical news. First and foremost, let's talk about the national debt. I talk a lot about this. This is the big discussion in Washington. They want to cut spending. We're at a gridlock. I'll talk more about that in a little bit here. But that is not going down, folks. And if you go to the Federal Reserve in St. Louis, they have a website where you can go in and pull up your own charts. I pulled some charts up here for you. Look at the personal savings rate, folks. Personal savings is now dropping down. We're now back into a downtrend, which means that savings accounts are depleting and people are just not putting cash in the banks. That's not helping the banks at all. So stay tuned for phase 2 of a bank meltdown right there. So that's personal savings rate. Next one, if you look at real disposable personal income, that too is trending lower. You see that? And so if people don't have money to spend, they're certainly not going to put it in the bank or contribute to their savings accounts. Look at the consumer price index, and this is the more realistic number because when you take out energy and food, that's basically worthless information that the Fed continues to pump down the pipeline there. This is looking more realistic here because this includes all items, including fuel, including food, and this is mainly in U.S. cities across the board. Look how inflation is screaming higher. That's not just trickling higher. it's screaming higher. Now, with all that said, look what's happening here to the velocity of money. I talked about this, 4 months ago, and I'm going to talk about it again. The velocity of money is basically where you take $1. They measure $1, and they look at how many times that $1 changes hands. So you go to the gas station, you put gas in your car, that dollar goes to the gas station owner, right? And then the gas station owner goes out and they go and spend money on maintaining that business. So that dollar makes another round. Then the person who gets that dollar goes out, maybe they buy a pack of cigarettes. They go out there, the cigarette company gets that dollar and they go spend it on more expensive. And guess what happens? Every time that transaction is made, dollars go into tax revenues. Well, when the velocity of money stops, guess what? Tax revenues drop. The economy comes crashing down. And that's exactly what we're seeing here. The velocity of money, and we're talking about the M1, not the M2. They're pretty similar. But you could see here that we're not even close to seeing the velocity of money to where it was pre-COVID. Not even close. And so I believe we're going to come to a screeching halt when the GDP numbers come out. Watch out below. The markets, I think, are going to be shocked by the next round of numbers. And with that, take a look at what's happening in Washington. We are going to shut down. There is a 90% chance this is going to happen. There's still debates going on as I'm recording this, but it looks like we're going to have a shutdown on top of the UAW strike. Now, for those of you who have been watching the news, this is absolutely crazy. We have Joe Biden down here with his little ball cap. He got his hands on the bullhorn, and he's cheering on the strikers out there. He's encouraging them to stay strong. Well, what is he doing? He's encouraging the car companies to go out of business is what he's doing. He wants to push the EV market. It's failing miserably, but the longer the strike goes on, the worse it is for our economy. And I'm just making sure you're aware of that because this could be a very interesting weekend as we have a government shutdown. We have the auto workers are shutting things down. We've got other things going on with the banks. We could see another round of bank failures next week. And with all that, we have a market that's on pins and needles. So be sure you keep an eye on your charts. Be sure to plug into my webinars. Make sure you follow the midweek report. And again, go with that little button right there. Click on that subscribe button, and I'll see you on the next video. So long.